Welcome to this episode of Wall Street Frontline. In late May, long-term U.S. Treasury yields briefly climbed about 5.1%, raising fresh concerns about America's rising debt, large deficits, and growing interest costs. Once seen as the world's safest assets, U.S. government bonds are now facing increasing scrutiny, with global investors shifting capital to other markets. Today, we're joined by Coulton, Chief Economist at Fitch Ratings, to break down what's driving bond markets volatility, the Federal Reserve's next move, and what all this means for global markets. Hello, Brian. Thank you so much for joining us today.
Likewise, good to speak.
The first question is about the bond market. The 10-year Treasury yield has stayed around 4.5% for the past few months, and recently, the 20-year Treasury yield briefly broke about 5.1%. So what factors do you think have contributed to the recent turbulence in the bond market?
Yeah, the high level of US Treasury yields in recent months has been quite interesting, given that most forecasters are expecting the US economy to slow down. And normally you would associate that with a prediction that the Federal Reserve would cut interest rates, and that generally would lead to lower bond yields. But we've not seen that. I think a couple of reasons. I think one is that the tariff shock is as an adverse supply shock. It's going to have an inflationary component. So that's something that's going to have an influence on the Federal Reserve. Maybe not seeing rate cuts as quickly as you would normally expect, given the anticipated slowdown in the economy. But I do also think that we are seeing evidence, over the last 6, 9, 12 months, that the bond market's getting a bit more concerned about supply issues, and the context here is, of course, the Federal Reserve is reducing its holdings of Treasuries through the QT program a bit more slowly, but it's still offloading its portfolio, and so the Treasury has to rely more on the market. And the reality is that the fiscal deficit is still very, very large, and there's a lot of supply that the market has to absorb, and I think that's putting downward pressure on bond prices.
You just mentioned the risk of inflationary pressures. I also read in your recent report that U.S. inflation is projected to be around 4%, which is well above the 2% Federal Reserve's target, especially with household inflation expectations rising significantly. How do you think this will impact the Federal Reserve's monetary policy trajectory in the near and longer term? How many rate cuts do you project for this year?
Yeah, we're only projecting one Federal Reserve cut this year, not until the fourth quarter of the year. So we think they're going to be on hold for quite some time. As I say, despite our expectation that the US economy is going to slow down. Now, we published in mid-April a forecast that inflation in the US would go to 4.3%. That's maybe looking a little bit on the higher side now, given the recent de-escalation in the US-China tariffs. But even so, we definitely think there's going to be upward pressure, particularly on goods prices, as these increased tax rates on imports feed through to higher prices for US consumers. At the same time, the Fed's the other aspect of the Fed's dual mandate, the employment side, is still looking okay. I mean, unemployment is still quite low in the US. The labour market still looks relatively tight, so that they don't have that much to worry about at this point on the employment mandate. And yet inflation is still above their target if you look at the core numbers, and it's going to rise. And I think that's going to cause a lot of hand-wringing at the Fed. And I think the way they will respond to that is basically just to sort of sit tight for quite some time. Their view is that interest rates at the moment are still above what you would call a neutral rate, a rate that doesn't neither boosts nor depresses the economy. And so they still think that they've got a little bit of a tight policy stance, and that continues to be appropriate given this increased inflation that's coming. But also, as you mentioned, we've had 3 surveys now from the University of Michigan and also the New York Fed survey showing households really are worried about inflation. I mean, we've seen 3 to 5 year ahead inflation expectations go back to levels we really haven't seen since the early 1990s. Now, that potentially is a threat to the Fed's credibility. So we've got to be really careful about cutting rates into this environment, cutting rates too quickly.
You just mentioned that the labor market still looks fine right now and remains relatively tight. However, the president of St. Louis Federal Reserve recently said that business investments and hiring intentions are starting to soften. Have you observed similar trends, or do you have a different view?
I think we need to sort of distinguish here between what you would call the soft data and the hard data. So the soft data, you're asking businesses what they're going to be doing. You're asking households what they're expecting. Those surveys have definitely deteriorated. No doubt about it. Sentiment has fallen quite sharply. And hiring intentions in some of these business surveys are definitely deteriorating. But if you look at the hard data, sort of weekly jobless claims, which are a pretty high frequency real-time indicator. You look at the payrolls reports, you look at the unemployment rate. None of those indicators are suggesting the labour market is really suffering at the moment. So I think the negative impacts of all this on employment and hiring are going to take some time to come through. I think we're going to be seeing the price impacts more quickly than we're going to be seeing the labour market impacts, I think.
How might prolonged trade uncertainty, along with inflationary pressures, affect Fitch's outlook for the US GDP growth?
I think one key aspect is if you look at measures of policy uncertainty, they've gone through the roof. So there's an index which spiked in the pandemic, and up until March, it had almost gone back up to that level. But then the April reading was just off the charts, the highest ever recording for policy uncertainty, and I think that's going to affect the way consumers and businesses conduct their everyday spending decisions. I think firms are going to be putting business investment decisions on hold. Now, how quickly that feeds through to the actual investment numbers, a lot of the capex that's done in any particular quarter reflects decisions taken, particularly years ago. If these are 5-year projects and stuff, so it might take some time. But I think there's definitely going to be an impact on the willingness of firms to start a new project. And I think that could weigh on investment over time. And if you've got slower investment, you're going to have slower growth in the capital stock, less capital deepening. That's going to weigh on productivity. So I think there are going to be some medium-term negative impacts on growth from all this.
Looking ahead, what key indicators or developments will you be watching closely to better understand the global economic cycle?
I think the first thing we'll be looking for, that we're likely to see, is evidence of the tariff shock on prices. Now, we didn't really see much in the April CPI, but they only really started raising tariffs aggressively in March, and then obviously in April itself. And we know that firms did quite a lot to bring forward. US firms did quite a lot to bring forward their imports from the rest of the world before the tariff hikes kicked in. So there's going to be a delay there, but I do think as we get into this early summer months, we will see the impact on prices. And then it's just seeing what happens to business investment, what happens to consumer spending. There's going to be a negative real wage shock for the US consumer. So it will be the consumer spending, business investment data, and that labour market data. The US has very good high frequency labour market data, monitoring that to see if there's a negative impact on activity, which we do expect to become increasingly visible as we get into the third and fourth quarters of this year.